Welcome back to another weekly market and financial update. So, as promised from last week we talked about the fact that the labor report was going to be released on Friday, and oh boy, it was released, right? The numbers came out and everything was pretty much cooler than expected. The jobs report did not meet analysts' expectations whatsoever, and the markets really reacted to that, right? We saw a lot of very short-term volatility within the markets. If anyone was logging into their accounts on Friday or really yesterday on Monday, you would have noticed that there were a lot of big swings and some big dips downward in the market. And this was really coupled with the fact that there already was some market volatility on the horizon that we had been experiencing. Remember, we mentioned last week that markets were already trending downward. September historically is not a great month for markets, but in addition to just overall September sentiment, what we were seeing was an oversold position within the market. So all that means is that people were sort of just rushing to sell their positions. And in addition to that, money managers of certain mutual funds were also taking this opportunity to lock in some losses for tax purposes for their investors. So, with all that in mind, we saw a few turbulent days, and again, the jobs report did not help. But knowing where the jobs report is, this is really a very, very key and important data figure, especially for the Fed meeting that's coming up later in the month. And the Fed is going to look at this data, and they're going to look at a lot of different data points, but in particular, they will hone in on the jobs report and utilize some of these numbers to say, okay, what do we need to do from a rate cut perspective? The European central banks have already lowered rate cuts now twice this year. They just announced they were going to lower rates for a second time just the other day. So I think at this point, it is extremely likely that the Fed will reduce rates. Now, here's where the question about how much comes into play. The Fed will utilize the jobs report data. They will utilize other data within the economy. We'll talk a little bit about earnings from companies in a second, but I think they'll really hone in on the jobs data and determine, okay, do we feel that a 25 basis point cut is necessary or a 50 basis point rate cut is necessary? And I think the 50 is probably less likely than the 25. I think the 25 at this point is extremely likely, and the 50 is only more likely if the Fed feels that the economy is starting to unwind faster than they anticipated or expected, and they're nervous about the economy going back toward sort of recession-based fears and a lot of other issues that will come along with that. So if they feel that's the case, then they'll definitely go with the 50 basis point cut. If they feel that that's not the case, which again, I'm personally leaning more toward a 25 rate cut, I think it would be a little surprising just because what we're going to talk about it right now actually is that earnings within US companies are still very, very strong. So, despite a lot of the recent market activity, and I know there's concerns around the election coming up later in November, but US companies have proved to be extremely resilient pretty much through COVID, high inflation, and everything else that's been going on. So the recent earnings per share data came in low double digits, right around 12%. And it actually would have been a little bit higher, around 13%. There was one company in particular, Warner Bros. They had a very, very large write-off, which reduced some of their earnings. So if we exclude Warner Brothers out of the overall US stock market and earnings per share, we're looking at 13%. If we bring them back into the picture, we're looking at about 12%. So, these aren't tremendous numbers, but the fact that US companies are still growing year over year on an earnings per share basis at 12% is a phenomenal sign, despite the fact that we saw this weaker labor market. Another key component of the labor market to look at is also the actual unemployment, which is sitting right around 4.2%. Now, typically with recessions or depressions, there are some major headlines normally that sort of precede these types of events. So if you saw the news on Friday and you had a lot of concerns about it, I think hopefully this should ease some of those concerns. And typically what happens historically leading up to these events is you'll see these mass layoffs, right? Lots of companies will say, oh my gosh, we need to get rid of expenditures because we're expecting issues within the economy and our own personal financial books, corporate books. And the number one expense for almost every major company in the entire world is their payroll expense. And what they'll do with that, of course, is lay off people, right? The easiest way to reduce payroll is just trim the payroll, right? And that's eliminating employees directly. So we're not seeing that. And I think that would really be the big indicator, at least to me, really the obvious one that stood out and said, my gosh, there are all these layoffs. Unemployment rate is starting to really spike up very, very quickly. We saw maybe a 4.2%. Now we're at maybe 5.5%. I think that would cause the red alarm in the Fed to say, wow, we really need to reduce, the rate by 50 basis points. But we're just not seeing that. Unemployment is still sitting very, very comfortably at 4.2%, which is really a low number in the grand scheme of things. So again, with all that in mind, I know the labor reports on Friday weren't great. They weren't the worst news in the world, but they weren't great. And obviously the markets reacted accordingly to that. But again, we've been talking about, if you've been watching these videos, you know that we've been discussing a lot about there will be some volatility within the next few months, and that's going to continue, especially as the economy is continuing to cool, and the labor report is a big indicator that the economy is in fact cooling down from where it once was. So again, this is exactly what the Fed planned for. I think they're doing a good job in maintaining this course of action, and I think they'll continue that precedent when they meet later in the month and hopefully reduce interest rates a little bit. So thank you so much for tuning in today. I know we talked about a little bit, but there was a lot of key data points that came out, so I wanted to try to discuss everything for everyone. And if anyone has any questions or wants to discuss any of this further, or if you have something in mind you'd like me to discuss for our future videos with market videos, then you're always welcome to reach out. I always take feedback as a welcome sign. So again, thank you so much for watching, and I'll see everyone next week.